I got to tell you something. I dig that music, that guitar riff. I mean, that is fantastic. Guy Adami, Dan Nathan, Wednesday, Novi the 2nd. Novi is the letter X. We can talk about that at another time. In just a few minutes, Tom Sosnoff, founder and CEO of tastytrade, will be with us. Today's episode is brought to you by FactSet, financial data and analytics that, Dan, are powered by tomorrow. tastytrade, empowering, again, to use the word, I love that, the individual investor through content, technology, and know-how. And I know how to make you smile, Dan, because I will bring up the fact that the Phillies of Philadelphia throttled the Astros last night. And it's funny to hear Met fans out there try to somehow justify the Mets season by saying, well, the Phillies are, you know what, Met fans? Loser move. How are you, Dan?
I'm doing well. You know, Guy Adami, our market call fans may care to know this. You and I were hanging out in New Jersey last night. Guy Adami was honored by the Tri-County Fund, which is an amazing charity that they raised while this event was going on. And you were one of two honorees. They raised over $2.5 million for kids of underprivileged backgrounds, many of them immigrants new to the New Jersey area, so they can go to some fine academic institutions, both undergrad and grad. And it was really fun to be there with your family and watch you being honored, tell a joke about nuns right to their faces in the audience. It was pretty amazing. But Guy, honestly, it was amazing and an amazing event, and you deserve that honor for all the hard work that you do to raise money for the kids.
Well, I appreciate. Listen, I don't deserve anything. It's just nice to be part of an organization like that. It was great that you and Sarah Nathan were there. Stephen Rafis came out.
Rafis was
PLL.
There. You know who would have been there? Amanda would have been there if she was up here, and our main man Jacob might have been there. All right, Guy, let's get into it because this is one of those days. I think there's 10 days a year, okay? 10 of them, only 10. And I know you wish there were 12, okay?
Oh, yeah.
But where the FOMC, the Federal Open Market Committee, run by the Honorable Jerome Powell, okay? He's going to come out with their rate decision. We all know it, the CME FedWatch tool, you know, a 90% likelihood that they're going to raise 75 basis points, the fourth consecutive one here. Now, the real issue is going to be what they have to say and what Fed funds futures start pricing for the December meeting. But what's your take here? Because the street is all over the place as far as what happens next, Guy.
Yeah. So I'll give you my hot take. Not that it matters what I think, clearly, but everybody's opinion is worth something. You know, I think that the market bounce and the fact that things have sort of stabilized on the bond front and on the equity front since, you know, basically the 14th of October gives them the latitude and the flexibility to not only raise by 75 basis points, but continue to speak in terms more hawkish than I think the market wants to hear. So I think we'd be having a much different conversation if the credit markets were melting down a bit, if the equity markets were melting down, and if bond volatility was still ridiculous. I think this conversation would be much different. But given the fact that things have stabilized, and again, I'm not saying they look at this, but if I look at it through the lens, this gives them a lot of flexibility to continue to be hawkish and, in fact, hopefully talk down inflation rather than act upon it. So that's how I look at it.
Yeah, so this Bloomberg article is kind of interesting here. There's still a couple banks out there that are expecting 75 basis points at this meeting and then again in December, which, it seems very unlikely unless the Fed has a peek at that jobs data that's coming out Friday morning and it looks really hot. I just would, be really surprised to see. But, Guy, this one is kind of interesting when you look at the performance of the S&P 500 on Fed days. Now, here's one thing. You've been in the markets for a while. I've been in the markets for a while. Sometimes that first reaction to the Fed announcement, okay, it gets reversed the next day. And sometimes it gets reversed the next day to just really, a magnitude of the day on that move. And we've seen that a couple times this year. So the fact that we've seen over the last, 5 or 6 meetings when the Fed started raising rates back in March, some up days, okay, I think it had to do with what you're saying is that rates had started to go up into the meetings. The stock market had started to go, down into it. And you saw a little bit of a reversal, at least for that afternoon.
So I'm glad you brought that up because we have seen that obviously a number of times over the last couple of years where the initial move turns out to be the wrong move. So I would submit if they come out and it's interpreted as dovish or whatever, or market friendly, this is the move that I would fade. And I say that under the context of we've been talking about the potential for a move to 4,000 in the S&P since the aforementioned October 13th, 14th, and then at Monday the 17th. And that's actually playing out. The S&P traded north of 3,900 yesterday. But if, in fact, you were to see a move of that magnitude post-Fed whatever, that's the move you want to fade, Dan. And listen, if it sells off on the back of it, then we'll have a different conversation. Then we say maybe 39.25 was enough. Maybe that almost 13% rally off that. I want to say, what was that low that we saw? 34.91 or so low.
Yeah,
maybe that's enough. So we'll see.
Yeah, here's one thing I'd say, though, Guy, is that if the Fed does 75, and it almost sounds like a kind of like, foot off the pedal, and they're actually explicit about that, you do not want to fade that move, because the S&P will be at 4,100 in a blink of an eye. And I don't mean like today, but it could be on its way with a follow through tomorrow, by the end of the week, that sort of thing. And let's just say that housing data is soft, or excuse me, the jobs data is soft on Friday. Well, then you're going to have a continuation of this rally through the midterms, right? And again, the expectation in the midterms is that the Republicans at least take the House, maybe they take the Senate. In that scenario, that's usually market positive. But Guy, you and I are also really focused on rates here. The 10-year U.S. Treasury yield, we had the chart up yesterday at Market Call. It's contending with that uptrend from August, when it was basically back below 3%, as close as 2.7 or something like that. I mean, if it breaks in a meaningful manner, if the Fed really does suggest that they're done with the meat of these hikes, that 10-year is going back to 3.5, also in a blink.
Yeah, and you can trade that vis-a-vis the TLT. There are a number of different instruments you can trade it, but I'm of the belief that yields are going lower now. I think they probably do it for different reasons than other people, and maybe we don't share the same explanation as to why that could happen. I think yields are going to go lower because things are slowing down in a meaningful way, not only here, but globally. Now, the flip side of that coin, of course, if China's zero COVID policy goes away, what does that do to rates? And what does that do? So does that reaccelerate things? So there's a lot to take into consideration here. I look at this and think 10-year yields are headed lower. I think I share your view that in the short term, the dollar might have topped out, although I do think the dollar is still a long side trade for the long term. And we'll see what it means. The S&P 500, I think there are people that think if rates go down, S&P has to go higher. And I understand that. I'm not one of those people.
Yeah, no, I guess my take would be that investors, at least in the equity markets, are a little optimistic here. Maybe it's seasonality. Maybe it's that they are pretty well convinced that the Fed is going to stop raising at the pace in which they have been. Again, my trade in the dollar has been the UUP, the ETF that tracks the U.S. dollar index. I am long puts in that in December expiration, and then playing for yields lower, the GOVT, which is an ETF that tracks different maturities as it relates to treasuries. I am long calls of that in December, which would be playing for yield lower. All right, here's one that is actually very much related to all of the above, and that would be crude oil. We haven't talked about crude. I'm actually really interested in getting Tom Sosnoff's take on crude. He's had a really good directional call since we started doing Market Call with him over the course of the summer. He has been bearish of crude, but when I look at this thing, Guy, look at that little smile. What does that thing look like it wants to do there? The 1-year chart.
Well, I mean, I know you say this. It's like I said it before. I think on one of our calls. What's that group that the three dudes with wore the hats sideways?
Yeah, the Beastie Boys,
I think Staten Island or something.
Yeah,
Brooklyn.
Is
that where they were from?
Yeah, the Beastie Boys.
Yeah, when they sang that song.
They wanted to fight for the right to what?
To party, which is exactly what crude oil is about to do. See, we didn't rehearse that. Probably really
not well enough. Well. We did not.
No, I do think that's the case. And one of the things that I've said, and I do want to hear Tom's thoughts as well. I thought post midterm election is when said crude oil is in fact going to party, because all the political rankling around that commodity will be basically gone because nobody's running for anything for the next 2 years. So I think that'll be left on the back burner. And I think the underlying commodity can go higher, especially if said Federal Reserve is in fact dovish in their tone.
Yeah, and I guess listen, you've been long of and pounding the table for the last couple months of oil stocks here. The XLE, I got to tell you, you look at this Energy Select
Ooh.
ETF. We know that Chevron and Exxon make up more than 40% of the weight of this thing. Now I know that you've been bullish of this thing, okay? But what do you see there, guy? Rafus drew the lines there. What do you make of this XLE chart on a 1 year basis?
Rafus is, I mean, it's amazing to watch him blossom right before our
Well,
very eyes.
just he did do this chart with his
I,
right hand.
I,
So I
well,
just want to be really clear on that one.
no, well, he needs, listen, if you want to be an elite player in any sport, especially lacrosse,
Yeah.
you have to be able to play with both hands without
Yeah.
question. You have to be able to do
Well,
things
we're
that
working on
most
it. We're
other
working on
humans
it.
can't. But
Yeah.
what does this tell me? It tells me it's a bit of a double top. And if I didn't know what this was, if my dogma was out of the way, because I am dogmatic when it comes to these things, I'd be telling people, you have to take some money off the table and look for a back and fill, not necessarily to the 200-day moving average, but probably the levels we last saw in mid-August when we topped out. So that's how I would be looking at this, and that's probably the right thing to do. I will tell you though, Dan, I think there's a very good chance that this thing breaks through to the upside post-election, when things seem to settle down on the rhetoric front.
Well, I'll just tell you, guy, if you zoom out here, and again, if you want to
Like
stick
that
to
show, by
your
the way,
if you
Zoom.
want to stick to your dogma, I
Yeah.
mean, here's a 10-year chart of the XLE. And so could you see yourself getting back to highs, that we see from the early teens, the 20, I don't know, I guess it was 2013 or something like that. Okay, maybe, but here's the deal, man. I mean, if we're right on the dollar near term, I'd just kind of be hard pressed to see a breakout above that, because that would be the most. If we see the XLE somewhere in the mid to high 90s, I mean, this would be the mother of all double tops.
Listen, I'm with you. And again, that's why people say things are priced to perfection. Well, if things were priced to perfection, they would never move. But the reason why things move is because two people can look at the same thing and interpret the same information and come to vastly different conclusions. And that's why, and I'm not trying to be glib,
No,
but
I
that's
know.
why things move the way they do.
But it's funny. So we take a look at charts. We take a look at a lot of data. I mean, last week we had John Butters of Earnings
Love
Insight
Butters.
fame over there at FactSet, and he gave us a bunch of data in his weekly blog about just the contribution of energy and the percentage of the S&P 500 and when it's going to start trailing off, which is going to be in the second quarter of 2023. When you think of the contribution of earnings growth, and if we are going to have a weaker economy, I just can't imagine that if we're already expecting weaker earnings from energy companies, that is going to be a great place to be. So I literally think we're like in the bottom of the eighth here for this energy trade, in my opinion. And maybe it does get to those levels, the XLE, with a breakout of crude oil, but I think it's going to be short-lived. All right, guys, let's quickly hit some stocks before we get to Mr. Sosnoff here. Look at this chart that Amanda put together, the NASDAQ 100, the QQQ. We know that Microsoft, Alphabet, Meta, Amazon, Apple, okay, over 40%-ish of the NASDAQ 100. They all reported last week. Look at how Microsoft, Alphabet, Meta, and Amazon, guys, they are all making new lows, okay?
As we speak.
As we speak, after those big earnings gaps here, some of them bounced a little bit after the gaps, and then Apple is filling in a bunch of that gap that it had here. Look at the bounce in general in the NASDAQ 100, the QQQ. It feels like at a really dicey spot, and that was not a great rally in this
Feeble
index here.
is the word. And one of the things I said on Fast Money the night that both Amazon and Apple reported is listen, Amazon traded down to $90. It was down, I think, 20% or thereabouts, which I don't think we've ever seen a move to the downside of that magnitude. If we do, don't at me, but I don't recall one. And what I said that night is, look, I mean, the Apple quarter was fine. It wasn't great. And their guidance clearly was not great. But the fact that it was holding in there, and remember, that traded down to 138 at one point. Next thing you knew, the next day it was trading in the mid 150s. And what I said on the show and what I said here on Market Call is, I think Apple is benefiting from the weakness in the four names that we just mentioned, specifically Amazon. And I think it's this flight to quality that people find themselves in with Apple. That will be short-lived, though, and I think we're seeing it right now. So in my opinion, again, I'm not an Apple hater. I don't particularly care one way or another. It's interesting, though, somebody said on Fast Money that Apple makes products that we need in our – no, they don't. they make products that we think we need. Let's not get carried away with how
Yeah.
important they are to our daily lives. With that said, they're not going to be impervious to what's going on globally in terms of this slowdown. And I think Apple at some point is going to fall under the same things that those other 4 stocks
Yeah.
have fallen under.
Yeah, and listen, full disclosure, in the last few days since those big gaps, I bought a little Meta and I bought a
Yeah, you
little
did.
Amazon. I'm down in both of them right now, and again, Amazon, I think in the pre-market after their initial results, guy, when we were on Fast Money, we were talking about it last Thursday. I think it was trading at 90, and it opened interestingly around 99, traded as high as 103. Usually, and this is an old school kind of trader trick here. Usually when you see some of those pre-market gaps and there's a bunch of volume that traded at those levels, but then when the market opens and it never really trades at that level again, usually they kind of go back there. And so we could be seeing that in the Amazon. I might be buying a little more down there at 90. And then this Meta, really does trade like it's going to be, in the mid to low 80s in the not so distant future here. So again, careful buying falling knives here, but I'm kind of legging into positions and looking for a late year rally in some names that were once much loved and very much out of love right now. All right, guy, Qualcomm reports after the close tonight. You've been talking about this name here. Again, not a great rally.
No.
AMD reported last night. The stock up 1.5% after being down, close to 60% in the last year. Not a great rally here. Thoughts on just semis in general and what you're expecting out of Qualcomm?
Yeah, I thought AMD would bounce a lot more than it did. I thought the quarter was good enough to see, just a relief rally, and you're really not seeing it in a meaningful way. So that actually makes me even more concerned about what Qualcomm's going to say. Look, if you look at the technicals, there's been no bounce whatsoever. Obviously, semi's been under pressure. The reason why I've liked Qualcomm for a number of months, and specifically late last year, was solely on valuation. I mean, it was a name trading at a significant discount to its peers, and maybe rightly so to some extent, but at a certain point that was going to change. And that happened. If you look at this move we saw in the stock, it's given the entire thing back. And it's at levels now where it's not bouncing from. So I am 100% concerned here about Qualcomm. The way to trade it, by the way, I think, is to wait and see what they say. Hope you get a flush and then try to buy it on the subsequent shakeout on the downside.
Yeah, I'll just say this, when you look at, who their customers are, Apple and Samsung are about 40%, and then you have Xiaomi, you have a bunch of China Unicom. So again, I can't imagine the guidance is going to be particularly great here. Okay, real quickly, last thing, guy, and I just maybe get a quick comment. There's a couple big names in the way I think about them, and they're not like massive names here, but Airbnb is down, close to 11% as we speak. Zoominfo down 26%. And I just wanted to highlight these charts in a way where they're making a series of higher lows. If you look at them, and they both just blew through those uptrends, and you see the really well-defined downtrends. And I bring them up because, again, it just shows you even down, 50, 60% or so from their highs, there's still plenty of room to the downside in some of these names that are still trading expensive when they're basically, not executing particularly well in what we can all agree is a difficult environment.
You look at that pennant, and if you're just again forgetting about the Airbnb, the A in my dawn trade, I mean, it broke on the downside, so it stands to reason we're probably going to make a move to the July lows, and we'll see what happens if and when we get there. But the only reason to buy this stock, to me, at this point, is if we break the downtrend line that's been in place since the spring, and obviously we're not close to that. So how do you play this? I think either wait for the lows to be made that we saw in July and hopefully get a bit of a double bottom, or potentially buy it on a breakout through that downtrend line, which we're nowhere close to.
Yeah, I guess the last point I'll just make is I'm looking at all these SaaS names trading really poorly. I look at all those mega cap tech stocks that are trading very poorly today. They really trade like that rates are actually going to stay bid here. You know what I mean? When you think about, what has been the knock-on effect from higher interest rates over the last year, it really has been to sell high valuation names. And that really feels like a precursor for what we might see this afternoon. Okay, that's it from us. You're probably sick of listening to us. Let's bring a smart guy on here, guy.
Tom Sosnoff. It's interesting. Sorry, Tom, to keep you in the. Oh, I love your backdrop, by the way. We mentioned this guy, John Butters. It's like Cher, Butters, Cher, Bono, Sting, The Edge, all that shit. I wish I could say the same. When you have a name like Tom, though, it's hard because there's so many Toms out there. Personally, my favorite is Tom Jones, who was slaying it in the 70s. I mean, women were throwing their panties on stage for Tom Jones.
Jeez.
I'm a huge fan. I'm also a huge fan of yours. How are you now? I want to get right into it with energy. A lot of people have questions. You've seen the political rhetoric. I know that doesn't come into probably how you trade these names, but talk to me about the energy space now, because it's clearly front and center, not only in terms of the trading world, now it's there in the political world as well.
I think it's goosed. I wouldn't touch it. I mean, not from the long side. I think I think across the board, these energy stocks, ETFs and the individual stocks, they're all sitting up at, they're all at ridiculous levels relative to where I think energy is. I mean, if you've been watching the way natural gas and crude oil are trading, they're not trading that strong, but the ETFs and the different stocks are. I don't like them up here. I think listen, I don't know if they're going higher or lower, but what I do know is I hate the pot odds up here. So I don't like the up. I think the payout is multiples to the downside that it is to the upside. So I don't like them. So I have positions on in almost all of them, but I'm more short premium, short delta than anything else.
Yeah. So Tom, when we think about that, and I agree with you, especially with the XLE, how do you think about trading instruments like an ETF where two names, Exxon and Chevron, make up, let's say, more than 40% of the weight? Does that the sort of thing that kind of leaves you, I might as well trade like one of the underlyings or trade options in and around them?
They all, like, listen, I'm an option trader primarily. I don't trade a lot of stocks. Yeah. So Exxon, Chevron, and XLE, they're all okay trading vehicles. Like, none of them are great. Exxon and Chevron probably trade the most liquid of those two, believe it or not, more so than the ETF. But I don't love any of them, so I mix it up and just do, relatively small trades in all three of them. I throw XOP in there too. I think the worst trading vehicle of them all is USO, and I think OIH is fair. So if I was ranking them in order, I think, XLE is probably XLE and XOP are 1 and 2, followed by Exxon, Chevron, and then USO and OIH.
Yeah, I understand what you're saying. I mean, OIH is basically 50% of 3 stocks, Halliburton, Schlumberger, and to a lesser extent, Baker Hughes. So I totally get what you're saying. And look, I mean, I can wax poetic about the flaws in many of these things, but that's for another show. I want to set you up with this, and so indulge me for a second. I moved from the commodities world to the equities world at Goldman Sachs, and I was sitting on the desk. I was not part of this conversation, but when you're on a trading desk, you hear everything that goes on. And Lloyd Blankfein, who was running the place at that time, came over and had a conversation with Eric Mindich. Eric was the youngest partner in history of Goldman Sachs at the time, and he was asking him what positions he had on. And Eric was saying, we're long this, short that, we have a pair trade on. And he went on for about 10 minutes. And Lloyd says to him, and I'll never forget, he says, how do you know what you're rooting for? And that really resonated with me, because if you long something, short something, how do you know what do you want this to go up, that to go down? It's very complicated. You talk about spread trades, which is different than pair trades. And maybe you can sort of, amplify that, because I think it's a really important distinction, and it's something you do all the time.
Yeah. A pairs trade essentially is what we call, it's essentially a basis trade. So you're right. It is confusing. You're not actually betting on one or the other. You're betting on the spread itself. So anything that has the term like basis spread in there, you're betting on the spread between the two, and you're not betting on either individual underlying. It's a little bit confusing for most people, most retail investors, but we've been, trading pairs now on, I guess, on virtually every retail platform. They offer some on the advanced platforms. They offer some kind of pairs mechanism, and we've built a couple of them for different platforms. So the advantage is, it's real simple. The advantage is they reduce your risk, they reduce your capital, and they extend your duration by reducing your risk. So there's 3 aspects to a pairs trade which turn people on. Lower capital requirements in based on how the CME charges for them. Lower capital requirements, reduce risk, and a lower standard deviation of risk, and an extension of duration. And those are important to people. The way the exchanges look at pairs trades, just to put some context around this, is they look at it as an 80 to 85% reduction in risk. So when you think about that, okay, well, if they're looking at it that way, then that's fair for me to look at it that way. So that just means that, they have an inverse relationship with each other, or they're inversely correlated.
Yeah. Hey, Tom, can you help us put some context on this? And again, I think our viewers here are pretty familiar with the fact that there has to be some pretty unique situations where you're going to make an outright directional bet, you
Mhm.
know what I mean, on
Yeah,
something.
sure.
But, we were talking about, and I know you care about this, the gaps that we saw after Amazon, Alphabet, Microsoft, and Meta, they're saying something to you, whether it makes you like think about a directional view of the broader market or a subsector or whatever. They were big gaps. The stocks, the sentiment was bad and they gapped lower. And here we are, for the ones that reported last Tuesday, a week later, making new 52-week lows, like an Alphabet here,
Yep.
a Microsoft's about to. What does that say to you about the prior leadership? Because we're basically anniversarying the 1 year highs, the all-time highs in the NASDAQ. And again, there was so much positive enthusiasm around those 5 or 6 names in general. What is it saying to you right now as we kind of limp into year end?
Well, I think there's a couple of messages here. The first message, getting back to the earnings story, is that of all the different times of like everything people talk about, gap ups and gap downs and all this kind of stuff, and different binary events like earnings. The one thing that we've been able to at least quantify statistically is that when stocks have bad earnings, they tend to have some continuation of that downward move for a period after the earnings. So whether it's 2 weeks, 3 weeks, or 4 weeks, most stocks that have bad earnings tend to work their way lower. Most stocks that have good earnings tend to work their way higher. It's like a 2/3, 1/3. So that's at least there's some statistical significance to that. The second part of your question, I think, is a much bigger, view of markets. I think a lot of us thought that the disruption to the tech sector was coming, but I think we were years early. Like I thought what we saw in 2022, I was going to see in 2019 and 2020. And it really, that rally extended probably an extra 2 or 3 years. And I think they got to a point of frothy, they were frothiness to the extreme. And on the one hand, yeah, it surprises me that, stocks like Amazon have dropped by over, whatever it is, 50, 60% off their highs, and other stocks, Facebook are probably down 70% plus, close to 80. I mean, that does surprise me. A lot of these tech stocks where they're trading right now, so the magnitude of this down move and the velocity we've seen recently, it does surprise me. But looking back at it a couple of years ago, I think that it got to levels that were so unsustainable and so ridiculous, and we all just took it like, oh man, that's what these things are worth. Like we almost got, they almost sold us. And I think we just got a blast in the face, a real reality of how how sentiment can change, and how markets can normalize price in a relatively short period of time.
No question about it. And I'll say, and I'm paraphrasing, but one of the reasons why people were led to believe that is Jerome Powell at one point, and I'm paraphrasing, so don't at me, but he effectively said, in a zero interest rate environment, valuations really don't matter. So when you get the green light from the person that's running the entire thing, I mean, you can understand why people would make that leap. But that's for another show as well. Obviously, Fed's front and center. And Tom, 2 weeks ago, we had a really good conversation about your view on the dollar. You called it a generational opportunity, I think, in terms of how overvalued things are. And that's playing out right before our very eyes. You obviously have positions on going into this thing because we know you and we know how you operate. And it's wonderful to have you here on this day. How do you set up into this? Because, again, it's not so much the 75 basis points that's going to happen. It's sort of the language used around it. And I tell you what, if in any way this market interprets that language as dovish or pivot or whatever bullshit word you want to use, the dollar's going to get crushed. Do you take things off into that?
So actually, this is one of the rare events today. I could have said the same thing last time though, so I guess it's not that rare. But when looking back in history, rarely are you at a price extreme levels like in the bonds and the dollars that you're at right now. And so when I look at the US dollar here, to answer your question, no, I am not, I didn't liquidate one position. I am essentially, I'm as long currencies as I've, I didn't get extra long today. I'm just keeping my existing position on. I am long yen, I'm long euro, I'm long Aussie, I'm long Canadian. And and that's it. I mean, I basically have 4 or 5 different positions on, which essentially make me short the dollar across the board. And I think, Guy, I like it because I think it's a great pot odds play.
Mhm.
I have no idea what's going to happen, and nobody does. But if, like you said, if I'm wrong, I think the downside is limited because these things are so oversold and the dollar is so overbought. If I'm right, I think the upside is multiples of the downside. So this is not a function of us sitting here saying, hey, you know what? We know what's going to happen, because we don't know jack. What I think we do know is that if we are right, we are going to have more velocity and more magnitude to the upside in these currencies and more downside in the dollar than the other way around. And that's it's just a pot odds play. It's just a bigger payout than you're taking risk.
Hey, Tom, here's a question. We got a ton of comments here. And we always get a ton of comments when you're on, because I think the
Sure.
people who are watching this live, they love, and I'm sure they watch you on Tasty Trade all morning and talk about the setups and
Sure.
what you like and why you like it. Here's one from Jim Trader. What would be a pairs trade in oil if Tom could give an example? Because do you ever get a bit granular here where you might be short of the commodity and long in equity or something like that?
Yeah. So an oil pairs trade is really hard, because the old school oils pair trade would be oil, natural gas, but that thing blew up about 6 years ago and has never come back. So the old ratios, like they do gold silver ratios, and that would be a classic pair, gold silver. The old energy ratio, the old energy pairs trade was crude oil, natural gas. And that relationship has been so out of whack for so long now that I don't think there's a person left that's traded it. So I think if you're going to do an oil pair trade, you're either going to do it with using underlying crude and doing any one of those ETFs that you want to. Like you can do crude versus oil services, like Guy was talking about before, against Halliburton, Schlumberger, just in an OIH type situation, or something else. I actually don't like crude oil pairs for that reason, just because if I was doing a crude oil pair, I'd do it against the S&Ps more than I do it against the individual stocks. The crude oil is not a great or energy is not a great pairs instrument, because it just doesn't have a really nice non-correlated product. But a mistake that a lot of people make is that they're not comfortable yet trading commodity options. And listen, I'm indifferent, so I don't care what the product is, but the crude oil product, the basic CL, which is the future in crude oil, the options trade one tick wide. I mean, every single spread in there trades one tick wide. And so if you're not using those products, and they have a micros too, if you're not using those, you're putting yourself in an illiquid position for something that you should be super liquid on.
Look at something like, and I don't want to take you necessarily to the Chinese market, but I will for a second.
I'm all in on China.
Yeah, so let's talk about that for a second, because last week Alibaba traded down to $58, traded 100 million shares, and this is a stock that was north of $300 this time 2 years ago. Not that that's important, just for context, a name that's made a 6-year low, but during that period of time, I would say at least 8 or 9 times you've seen 35 to 50% bounces in the name. And I would submit we are now set up for a similar type of move. So do you look at that and say, here's a great opportunity to sell puts, or, walk me through, because my sense is you're looking at it the same way I'm looking at it.
I'm 100%. I'm agnostic to what I trade. I'm an opportunist. That's it. And China is the most ridiculously oversold sector in the equity marketplace. There's nothing like, I look at some US tech stocks now and they're getting cheap, but nothing's cheap like China is. So I look at Alibaba. It could be Baidu, Baba, JD, PDD, FXI. Just take your pick. They're all liquid. They're all reasonably liquid. Baba and Baidu, probably the best two. JD and PDD just slightly behind that. FXI is fine, of course. But I look at these stocks the same way I look at the US dollar trade. I think there is massive upside. I think there is very little downside. I think that 58 print blew somebody out. Immediately that day it closed, remember 62, traded up the next day to 68, and this morning traded up to 67, back to 66, wherever it's trading right now. But it's my single largest equity position is Baba. And for no other reason other than the pot odds in there. I could easily see that stock at 74, and I can, on the downside, I could see it at 62. So the way I look at this, it's like it's 2-1 or 3-1, on a short-term basis, just upside over downside. So yeah, I love the Chinese stocks here compared to a lot of the U.S. counterparts, just because they haven't had any bounce. I mean, they've been down. They went down first. They're going to go up first.
Yeah, and Dan's got a question quickly. I just want, if we could pull up an Alibaba chart real quick. I mean, if you don't think this happens, it happened basically around the 4th of July. I mean, this stock rallied, I think, almost 45% in 3 trading days. So it does happen. And, that's a stock that rallied, again, 50%. And here we are making new lows. So you do get these opportunities. Visually, I think this does more than me just talking about. Sorry about that, Dan.
No worries. Hey, so if they could throw up a Robinhood chart too, and really, again, this one came public.
Sure. I have a lot to say about Robinhood. So that's a good topic.
And you've actually had a brilliant call since we started doing this. The stock is up 75% from its lows this summer, and it's really fascinating when you look at just the relative strength to many names in finance and fintech, whatever you want to kind of categorize this one. And so they report after the close tonight, Tom. Let's say the stock's a little below 12. If I'm looking at the at-the-money weekly straddle that expires on Friday, okay, the 12 strike straddle, if I'm putting the call premium together with the put premium, I'm getting about a 13% implied move in either direction. Is that what you're seeing from the 12 strike? This is a tough one because this stock, if they were to just, if there's anything remotely positive, this stock's easily up that. That being said, I feel like the stock, because it's rallied into the print, could easily be down that, but you'd almost even want to buy that down move if it's nothing, disastrous. You know what I'm saying? If it's just kind of taking out some of that recent gain. So I'm just curious how you think about a name like this that you're positively disposed on, where the vol's high, but it could move.
Full disclosure. So I'm long Robinhood. They are a competitor of mine. And so I don't know that much about Robinhood, except that I understand their business as well as anybody, I think. I started getting long Robinhood on the way down I started buying it around, I started buying probably in $15, $17 range, but actually didn't load up till lower. I've got my cost basis now under 11.5, probably closer to 11, but I don't know exactly. I held it all the way down to the $8 level, $9 level. I haven't done anything in there. It's one of my biggest longs, not as big as Alibaba, but one of my biggest longs. And the only reason I've stayed long that stock is because in a rising interest rate environment and an environment where trading activity, specifically option trading, which is, essentially, we all know that their crypto business has gone to zero, which is, so write it off completely. Their crypto business doesn't even exist anymore. It's basically zero. But the OCC volume's been strong lately. It's been it's been up in the high 40s, 50 million, low 40s. OCC volume's been strong. Interest rates, they've picked up 400 basis points on cash balances. If they didn't blow the doors off, because every other firm has in this space, if they haven't blown the doors off, then they're just a horrible firm, and I misread them. Because you'd have to be, at this point, running a brokerage firm that didn't make money in a 400 basis point jump when you're self-clearing, and with an OCC volume increase of 20 to 25% recently, when that's your primary market, then you have a broken model and your firm stinks. So I figure they have to come up with something, I just can't even, there's no scenario I can paint other than they're just completely a horrible firm if they don't have good numbers.
Yeah, and that's probably about a fifth. That's the tail risk there, that they suck.
Yeah, sure, that's the tail risk. You're right.
But I think that's a price you're willing to pay given these prices. Now, Muhammad Ali, the greatest of all time, I don't think it's really him, has a question for you. And this speaks to seasonality. And I don't know how closely, I know you follow it. I don't know how important it is. But the question is, does a seasonally bullish environment right now that we find ourselves for the stock market work in a bear market that we're effectively in?
There's no such. So the simple answer to this is there is no statistical significance whatsoever to seasonality. And it doesn't matter if it's a commodity. So people always thought there was seasonality with crude oil and natural gas and corn, wheat, or soybeans. And you can tell by the way the markets act today, there is no statistical significance that we've ever been able to find through 11 years of research on seasonality having any there being anything to seasonality. So, I mean, if he's talking about like, the Santa Claus rally or the January effect or whatever else it is, every triple witching month, which would be March, June, September, and December, tend to have some natural bullish bias. At least that's the thought process. But if you look at the last couple of years, it's all been on the negative side heading into those quarterly expirations. So I would say that no, it doesn't mean a thing. But this year, Guy, and I mean, we've been down all year. It wouldn't be the craziest thing in the world for us to rally going late into the fourth quarter to reverse some of the negativity we've had all year. I mean, it's rare that we get 12 straight down months. Remember, we made a high January 3rd.
Yeah. All right. Well, listen, I mean, what, Guy, they say never meet your heroes. I was fortunate to meet Tom a long time ago. I will tell you this. I grew up in the business at a hedge fund with 2 phones on each ear. Okay. Hands have to be ready to go on a machine to trade stocks and doing futures. And I always thought, man, I can't imagine anyone trading as much as the guy I worked for back then. But all you have to do is tune into Tasty Trade every morning with Tom and Bats, and you will see guys who just can't stop, won't stop. And I love it because I think the idea generation is amazing. I just see all the comments that we're getting here. It's a lot of fun. Guy and I obviously take a more directional approach. So for us, it really helps inform some of the things we're doing. So Tom, thank you for joining us here on a Wednesday.
Love it, guys. Have a good afternoon. Good luck today.
And Tom, we're going to let you. We're obviously going to sign off here, but it speaks again, and this is a thing we talked about on day one with you: the power of the community that you've built and continue to develop and grow. And I think just from the comments we saw today, it speaks to exactly that. And when you have another set of eyes on something, when you can bounce ideas off other people, I think, just my opinion, but this actually is not anecdotal. I know it's from fact. It make you a significantly better trader without question. So obviously, Tom, again, thanks for your time.
You guys didn't ask the question I thought I was getting ready the whole time.
What's that?
What are bonds going to do this afternoon?
Nah, that's such a fucking lazy question. I wasn't going to ask you that because it's just such a bullshit. What are bonds going to do, Tom? I mean, that's like mail-it-in question. So I would never insult your intelligence by asking.
Well, hold on, Guy, because now that we're here and you got everyone kind of tuned up with your language here. Hey, Tom, what are bonds going to do this afternoon?
Well, right now, the bonds, we're talking about the long bond. It's up 10 ticks.
Yeah.
And I love trading it, and I'm long it. And the number of times that I've been long bonds in my life, you can count them on one hand. And this is in 40 years of trading. So it is very rare for me to be long bonds here today. But I'm going in, taking my long position into the number. Same exact pot odds scenario. I think there's 2 handles of downside max, and I think there's 4 handles of upside potentially in there. And I agreed with what you guys said earlier. You can easily see rates a lot lower by the end of the week, which means bonds higher.
Yeah. And listen, it's when they ask the questions, what's the unemployment number going to be? Let's go to this person.
Oh, yeah. Screw that. That means
just,
nothing. Yeah, that's garbage. Yeah.
But I like what you did. You got me tuned up, which is good. You meant listen, I love it, man. I'll go head to head with this stuff all day long, but we're not doing it the rest of today because we're out of time. Thanks for joining in today's Market Call. Obviously, thank our sponsor, FactSet. Thank Tasty Trade. Please check out the website at Tasty Trade. If you're looking for a community to trade with, they're the guys and gals to do it. If you enjoyed today's show, make sure you subscribe to Risk Reversal Media on YouTube. Like our video, leave some comments, whatever you want to say. We're game, as you probably can tell. We love hearing from you. Dan and I will be back tomorrow at 1 p.m. with EY from SoFi, whose Packers suck, whose Bucks are okay, whose baseball team is playing golf, and who have a lot of things to say about the market. We'll see you later.
All right, see ya.